markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
All right, what's up, traders? Aaron Fifield here, host of the Chat with Traders podcast. Thank you very much for tuning in to this week's episode. And for this episode, I interviewed Dr. Brett Steenbarger after many requests from listeners. Brett is a very well-known trading psychology coach and has consulted to some of the biggest names in the industry. He's also a respected author who has now published 4 books, some which have been recommended reading by previous guests on this podcast. During our conversation, I asked Brett how to break bad trading habits and introduce new best practices, to explain why traders need to be adaptable in markets, plus how we should think about goal setting and measure progress. And of course, much more about how to enhance your performance as a trader. Now, if you do enjoy the interview, please go ahead and leave an iTunes review. Like I've said in the past, it literally takes you 2 minutes. You can do it while you're listening, and it really helps to boost our rankings in iTunes and attract more listeners. So if you'd like to support the podcast, please go to chatwithtraders.com/iTunes. Okay, folks, let's skip to the interview. You're listening to the Chat with Traders podcast, and here is a very special guest for episode 65, Dr. Brett Steenbarger. Brett, many people have been asking for this, so I have to say straight off the bat, thanks a million for being here. I appreciate it, and I know listeners will also. How's your day been? What's going on?
The day's been good. Thank you very much, Aaron. And I appreciate the opportunity to be here and to share some ideas with the listeners.
Sure thing. The pleasure is mine. So, as most traders already know, you are the go-to guy for all things related to trading psychology. So, of course, that will be the ultimate focus for our chat today. But starting from the get-go, Brett, if you could, give us a little insight to your background. Like, how did you get into the psychology field? And where did you initially start out after getting your PhD?
Okay, yes, the initial impetus for my entering psychology was an unconventional one. I came to psychology via philosophy. As a sophomore in college, I was interested in psychology and indeed had declared psychology as my major, but I never really considered it a career field until I read a novel called The Fountainhead by Ayn Rand. And that novel illustrated something that I hadn't encountered before, and that is the vision of people as heroic, as reaching their ideals, their potential. And the thought came to me, it was during a winter break in my sophomore year, the thought came to me that this was a proper role for psychology to not just treat mental illness, but to expand the best of people's potentials. And that's what has interested me in psychology ever since. And what I do now in working with traders and portfolio managers, and earlier, before that, working with medical students and residents in the medical field, it really has been working with healthy people, people who are bright and creative and energetic, and helping them make the most out of what they do.
Okay, great answer, and very interesting to get your backstory there. So where did the interest in trading come from? Like, when did that creep into the picture?
You know, the trading thing is something that I first expressed an interest in a project when I was in grade school, and later became more interested in a formal way during my graduate school education at the University of Kansas. And I actually opened a trading account and began trading individual stocks. And that was in the late 1970s. But that was completely separate from my interest in psychology. My degree was in clinical psychology, and my interest was in becoming a psychologist. The trading was a side interest, a challenge, and something I found stimulating and interesting. And those two proceeded in parallel for a number of years. I pursued trading as an avocation, and I pursued psychology as my vocation. And it wasn't until around the year 2000 that I seriously contemplated putting the two of them together and began writing a book. It was my first book in the area, called The Psychology of Trading, which was later published by Wiley. And that was encouraged by my good friend and mentor, Victor Niederhofer. So that's how the two came together. But up to that point, for a number of years, they were completely parallel interests. The book became popular and was discovered by a trading firm in Chicago. And they began asking me to work with their traders and then made me a full-time offer. So I left the academic setting that I was in. I was teaching at that time in a medical school in Syracuse and also running a counseling program, and went full-time to working with traders in Chicago. And that's when the psychology and the trading interest truly came together.
Okay, excellent. So let's talk a little bit about your time in Chicago. Like, what were you doing? Like, how were you actually helping these traders with the mental aspect, the psychology, and everything that goes on that side of the field?
Well, in Chicago, I was working primarily with market makers in electronic futures. These were people placing dozens, if not more, trades per day. So trading on a very short time frame. The average holding period for many of the traders was around 3 minutes. So they are very actively engaged in markets. And it fascinated me because they were trading in ways that were completely different from what I had read in the textbooks. The books on trading talked about technical analysis, fundamental analysis, and these traders who I was encountering in Chicago did none of it. Obviously, they did no fundamental analysis because the fundamentals don't change in 3 minutes. But technical analysis in terms of chart patterns and indicator readings, those were much too slow for these traders. These traders were entering positions and exiting positions very quickly, and they were working off a depth of market screen. They were working off the order flow, not backward-looking technical information. So that was an education in itself and sensitized me to the psychological challenges that they faced in making decisions so rapidly. It was easy for them to become frustrated, to become overconfident, and for all of those emotional factors to slant their decision-making. And so my work as a trading coach was to help them keep a level head, keep focused, and make good decisions in real time. And the fact that I was full-time working with them, and so on site, watching them trade and standing with them and helping them really helped the psychology become part of the trading.
Right. Yeah, that's very interesting, Brett. And we're going to dig deeper into that in just a moment. A question I have for you is, like, over the years, you've been in the field for a long time now. You've worked with many, top traders, like some very, very hard-hitting heavyweight traders, asset managers, fund managers, they're a pretty broad spectrum of market participants. Now, these aren't all guys who are struggling. Some of these guys are extremely profitable and make huge amounts of money. Why do they come to you for your help on the psychology side?
It's a great question, Aaron, and it's the same reason that successful professional athletes work with coaches as well. At that point, they're not struggling. They would have never gotten to that point for in a large majority of cases if they were marginal participants. So these are people with real experience, real strengths. But what happens is that markets are always changing. And even the most talented participants have to evolve. with the markets. And that need to evolve itself brings its own psychological challenges. The need to be creative, the need to be resilient in the face of frustrations, and also the need to identify and build upon strengths. So many times, the portfolio managers are seeking me out when they are doing very well because they want to stay grounded in their strengths. They want to make sure they understand what they're doing well so that they can be more consistent going forward in making use of those strengths. And so that's the difference with working with someone who is struggling and wants to work on their weaknesses or vulnerabilities.
Okay, that's a great answer, and it makes total sense. I really like how you explained that. So, Brett, let's bring this up to speed now. What are you doing today? Like, what's your work involve, in current times?
Well, I work with several hedge funds and other financial firms. So I'm not full-time at any one place. I consult with a variety of funds. And what that's done is expose me to a variety of trading strategies. Some of those strategies are discretionary. Some are more systematic. Some of the strategies are more directional. Some are more based on relative value movement. Some are in macro markets, the big liquid markets, and some of them are very specialized in individual markets, such as commodity markets or rates markets. So I've been exposed to a variety of trading strategies and trading settings, and it's been a great education as a result. But in all cases, my main work is to help the traders, the money managers, with their performance, help them build on their strengths and help them learn from their mistakes so that they keep improving. A secondary focus has been at most of the places where I've worked, we've conducted internal research about what makes traders successful. And so I've been able to help the trading firms with their hiring processes and help them make better decisions about who to bring on board. So that's been a separate kind of work, but a very fulfilling area as well.
Sure. Okay. Now that's really cool. Now that we're caught up on your background, let's really hone in on the subject of trader psychology. So one of the things many traders will admit and are well aware of is that they take profits too soon and they cut losses too late. That's mostly due to psychological reasons, I'd imagine. What advice would you give to those traders in that situation?
Well, it's a good question, Aaron. And as Ayn Rand would say, I would encourage you and listeners to check your premises with respect to the question, because I think that it can be a psychological issue, but is not always a psychological issue. I mentioned that markets are always changing, and one of the ways that they change is in their volatility. And so the market, as we are talking right now, the market is trading with a VIX of, which is implied volatility, of 14 and change. It wasn't so long ago that we were seeing VIX readings well into the 20s. So markets were moving much more a few weeks ago than they are currently. What happens is that traders don't adapt to that, either in their trading or emotionally, and so they're likely to take profits too quickly or likely to allow things to move against them because they are operating from an old regime, from an old set of assumptions that don't apply to the current market. So a good example, when volatility comes down, traders will start to make some money, and then when they try to let the position go, it eventually just reverses against them because the volatility isn't there, and you get much more mean reversion on a short time frame, and so they end up scratching the trade. Whereas in a higher volatility regime, that might have been profitable. So sometimes a problem that trader might have is logical, not psychological. It's a function of not adapting to markets. It's a function of not trading well. But you're right. There are other times where traders respond emotionally to making money, losing money. And as we know from the behavioral or finance research, people are much more sensitive to losing money than they are making money. And so they're likely to be threatened by losses and not want to take those. They're likely to be afraid of losing whatever they gain and exiting trades early and so forth. So a huge issue in trading psychology is identifying when is a trading problem a logical problem, a problem with one's trading methods, and when is it the result of a psychological problem, the result of being in a wrong mindset that biases your information processing.
Okay, that's an awesome answer. That was really, really good. So, I mean, I guess that is an example of a lack of adaptability, and in some cases, possibly even a bad habit. But in general, when we recognize bad habits in our trading, what's the best way to break these habits?
The first step in breaking any habit, whether it's a trading habit or a personal habit, is to become exquisitely aware of its presence. So we want to become mindful. We want to be self-aware. We want to realize that a habit pattern is playing out as it is starting. So let's say my habit pattern is overeating. The first step in change is to recognize when I'm starting to feel a craving for food or when I'm starting to reach for the refrigerator. If I can't identify it at the time it's happening, how can I possibly control it? So building awareness and self-awareness is the first step in the change process. Then, once you have that self-awareness, once you can become an observer to your habit patterns, rather than someone who is caught up in those patterns, then you want to make a conscious effort to rechannel yourself. So let's say, for argument's sake, I have this habit of overeating, and I tend to overeat most when I'm bored. So I catch myself reaching for the refrigerator, and then I calm myself down, I focus myself, and I purposely engage in an activity that I will find engaging, that will absorb my energy. Maybe it will be some physical exercise. Maybe I'll go play with one of my 4 cats. But the idea is I would address the boredom so that I no longer feel the need to compensate with food. The same principle is relevant with trading. So my habit with trading might be to place trades out of frustration after I've taken a loss. Revenge trading. And so that comes from frustration. I have a losing trade, I'm frustrated, and I want to make that money back. So I want to become self-aware about that frustration. I want to catch myself being frustrated and rechannel that emotion. So stepping away from the screen temporarily, calming myself down, and doing something that is gratifying, that's fulfilling, to counteract the frustration will help put me in the right state of mind so that I can go back to the screen and make good decisions.
Okay, sure. And I like how you mentioned earlier in that answer about more being an observer to your bad habits than getting caught up in the middle of it. I think that was a really cool concept.
Yeah, the important one that shows up actually in Eastern philosophy as well as in the psychology research, that we can't change something if we're not aware of it. If the pattern controls us, if the habit controls us, then we're passive. We have no say in what happens. So the first element of control is being able to step apart from the habit pattern, whether it's a habit of drinking, a habit in trading, a habit in our relationships. We stand apart from it and we recognize that this is causing us pain, this is causing us losses, and then we're able to try and do something differently.
Right. Okay. Now, the intro to Trading Psychology 2.0, you mentioned that all the traders you've worked with varied greatly in how they actually traded, yet they had many commonalities in how they did what they did. So here you were, of course, referring to process and habits. Could you elaborate on these observations for us?
Yes, absolutely. Obviously, the traders I work with have very different strategies. Some are more short-term, some are more long-term. Some are long-short investors building very large portfolios among individual stocks. Some of them are trading macro assets globally and trading macroeconomic themes. So they're very, very different in their approach to markets and in their trading styles. But at a process level, there's some real similarity. And that's what I talk about in the Trading Psychology 2.0 book with those basic A, B, C, D themes. A being adapting to markets, B being building on strengths, C being cultivating creativity, and D being developing best practices. And so what the really successful traders are doing is studying themselves and figuring out what works, what they're good at, and where their vulnerabilities lie, where their weaknesses lie. And they do more of what works. They act in ways that make them more of who they actually are. And they may be different strengths in different markets, but all of them study themselves just as they study markets and stay grounded in what makes them successful.
Okay, so the A, B, C, D that you mentioned there, could you just walk us through each one of those in a little more detail, just so we can understand, get a better grasp of each point?
Yeah, absolutely. Yeah, so A, is adapting to changing markets. And this, as I point out in the book, is no different than it would be for any entrepreneur. You start a business and your marketplace is always changing. And so at one point in time, if you're starting a restaurant, your marketplace may have one set of tastes, and then something else will become popular. And so you have to adapt by changing your menu, by changing your decor, by changing how you deliver service. Successful businesses never stay static. We see this in the technology industry. New smartphones are coming out with regularity because the marketplace demands new features and functionality. So we're always having to adapt. Markets change in their trend. Markets change in their volatility, as I mentioned. Markets change in their patterns of participation. The people who dominate markets now are not the people who dominated 10 years ago or 20 years ago. And so we see different patterns in markets. To assume that markets are static and that our edge will last forever does not work any better in financial markets than it does in the business world. A great way to go out of business in the business world is to assume that what you're doing well will last forever and you never have to change. That's how to become a dinosaur. That's how to become obsolete. And that happens in financial markets as well. So the successful traders are always studying markets and always studying how markets are changing. And the interesting part, Aaron, is that many times our mistakes in trading, our losses, our setbacks, our drawdowns tell us about changing markets. Because we do what we did do when we were making money, and suddenly it's not making money for us. And if we're reasonably disciplined in doing what we had been doing when we made money, then we have to ask ourselves, well, how come it's not working anymore? What has changed? And that helps us go back to the market, learn from our mistakes, and adapt. So we're using our drawdowns, we're using our losses as real information that helps us adapt to markets that have changed their correlation patterns or their trend patterns and so forth. So that's adapt. That's the A part, adapting to changing markets. The B part is building on strengths, and I alluded to this earlier. What I found in my research with successful traders and portfolio managers is that all of them have different strengths, but all of them have at least one distinctive strength. And it could be a personality strength, it could be a cognitive strength, but the really successful traders are really strong in some areas.